This is New Home Insights, the John Burns Real Estate Consulting Podcast. I'll be your host, Dean Worley. As the title promises, we're going to bring you insights into everything housing, latest trends, innovations, observations, and issues of the day. We'll bring in colleagues here at John Burns and also some major industry players from all across the country. This podcast is going to be quick, fun, but also hopefully make you think. So see you here every couple of weeks. Now let's get to it. Hi, welcome to the latest episode of New Home Insights. I'm your host, Dean Worley. Today we have with us John Burns.
Hey, Dean. Good to be here.
We're here at John Burns Real Estate Consulting. We're actually here in lovely San Diego, California.
We're looking at the bay,
We are indeed. And we are kind of here at our mid-year retreat, seeing how the market was doing, talking about a lot of topics. So that's what we're going to talk about here today. We're going to talk to John about kind of what kind of trends and disruptions are happening in the market and how folks in the market can respond to these challenges and to these changes in the market. So we're going to start big picture. How is 19 going so far?
A lot better than the fourth quarter of 18, that's for sure. We just did our mid-year webinar for our clients, and I took some advice from Bill Gates, who said, technology really, you got to look at it over a 10-year period. So I looked back over 10 years. We've had 10 years of economic growth. We've got a tailwind, a 6% rental tailwind, and an 11% entry-level buyer tailwind helping us out. We've had mortgage rates now at 4% plus or minus for 8 years in a row. And not only are existing home sales and new home sales down, but even the revenue, when you multiply it by prices down, appreciation has slowed a lot.
Yeah.
I just think we've run out of steam. Most of the people who wanted to buy are in. They've got a great mortgage rate. Every time rates go up, the decision to move would be painful because you'd have to leave your good rate. And a lot of the economic growth right now, our demographer, Chris Porter's done some amazing research. It's really coming from people not retiring, just continuing to work in their 60s and early 70s. And they've already got a house.
They're aging in place, aren't they?
Yeah, so our rule of thumb about job growth creating housing demand really isn't. Now, there are some household formation data that shows that there are some households being formed, but we're building enough to satisfy demand at the right price points. I think most of the demand is at the lower price points and the lower rents right now.
Yeah, and so we still need, where the demand is being created in the entry level, that's just tough to make pencil for builders out there.
It's tough for everybody to pencil. So, I went back and looked at this too. So, existing home sales revenue and new home sales revenue are both pretty far below the peak. But if you look back to 99, which was kind of a normal-ish year, existing home sales revenue are 22% above 1999, and new home sales are 4% below.
Wow.
I mean, the new home market is just not coming back. I think our inability to build affordably, which can't be mandated by the federal government. It's really a local government problem at this point. And maybe there's some things that could be done to bring some labor back and things. But there's also been a shift, as I've seen it, and we covered this in our book, of people, dual income, college educated people not willing to commute. And so they're willing to, they will only stay closer in. There's less land closer in, so there's less volume for that reason. It's more expensive closer in, so we'll take something smaller in a townhome. And because this is what you do for a living, all the new home development has pushed to higher density, closer in, but still not that cheap.
Yeah.
That's what the demand is.
In Bay Area, the $1 million+ townhome is the new normal for a family with kids.
Yeah, and we're seeing $350,000 townhomes in Orlando. I mean, this is going on all across the country, and it's a permanent shift.
And in the live stage, we know that folks are doing things later, getting married, having kids. So when they really have to get the bigger house, whatever, that's happening later and slower.
Well, so there's some positive in that. So hopefully you're making more money at the age of 33 than at 28. So I think that's helping with the affordability. But I think you mentioned big houses. Clearly society has shifted away from a big house being my aspiration and something I own and I can call my own, and convenient is the aspiration.
And functional.
Oh, absolutely.
Time and time again, they'd rather have functionality over just sheer size.
Right. That's been the whole emphasis of our design lens research, as you know, is great functionality Pete Reeb's done some pretty interesting research for one of our clients on what they call compromises. What compromises are people willing to get? And it can vary a lot by market. We've seen in some areas like California, people will say, I don't need the dining room, I don't need the living room. You go to Utah, where Kristen Matthews is, and that's an absolute essential there. So it really is a market by market thing.
Now, you mentioned that new homes revenues have been hit harder than existing home revenues.
Yeah.
That's purely a volume thing, isn't it? Right? Because the delta between new home price and existing has never been higher.
So it's a function of two things. So you usually, it's apples and oranges here, but new homes are usually 20 grand more expensive than existing homes. If you look across the whole country, they're 60 grand more expensive right now. I think location is part of that reason. But it's smaller homes and functionality that people are after.
Yeah. Okay. So how about if folks aren't that need to live, need a new home, aren't buying new? What are they doing? What are some of the avenues besides the new home sector that they're looking at?
So a couple things. So Fannie Mae just changed the rules and allows some rental income now to qualify for your mortgage, and renting has become okay. Yeah. People, those born in the 80s, we call them the sharers, invented the sharing economy. If I can borrow somebody's prom dress, I'm going to do that. I'm not going to buy my own. It's just considered financially smart. So people are double and tripling up. We're seeing first-time buyers buy a home with a friend in tow to pay some rent. We're seeing more multi-generational living. And we called this out in the book, and people scoff when I say this, but I really don't think they're going to scoff 7 years from now. Because if I had told you people would rent out rooms to strangers, you'd say that's the stupidest idea ever, but Airbnb's proved that wrong. Yeah. Why would you rent out a room to a different stranger every week when you can rent out a room to somebody you can vet and they can become a tenant? And these people I talked about who are working later in life need the income, and it'd be great to have the kids in the house paying for it, but if I can't have my own kids, I'm going to rent it to somebody else.
And your own kids won't pay anyway. So it's it's a win-win. You get them out of the house.
Maybe your kids won't.
They won't. So, and there's natural places for that to happen, like college, major university cities where the older widow or even couple, the kids have gone as lots of kids. But do you see that happening generally?
Well, that's where it's trending first. There's actually a company in Boston, I forget the name of them, that actually specializes in hooking people up with college students, because there's so many college students in Boston, so many retired people in Boston. But I think that's going to take off across the country. And as I've been saying this, as I've been doing speeches, I've had people come up to me afterwards and say, you know what, I'm already doing this. And it's another 10 grand a year in income. We use it to take a nice vacation. We use it to buy gifts. And this is people who are already working.
Yeah.
They're still working, just extra income.
I've seen it. We've seen it with college. I have college age kids. And the room option is a very, very common option when you're looking at where they're going to live, if it's not going to be the dorm or whatever.
So the other thing I wanted to mention, because you alluded to it, was the pivot to rental. Now, you're not seeing it in the home ownership rate data, really, although Chris Porter, our demographer, has kind of busted them, and some of that data is wrong.
Yeah.
If you actually go under the hood in the data, it said that the absolute number of renters in the United States has actually fallen in the last 4 years, and that has not been the case because rents have grown and occupancy has increased. Okay. But the pivot we're seeing is to renting.
Yeah.
And the biggest boom in our business, as you know, has been the build for rent. We're seeing people are now saying, oh my God, you can have a company that manages detached homes and townhomes. In fact, I just looked up something pretty interesting on that I'll share with you. So Lennar and Horton are the behemoths home builders, and their market cap is $16 to $17 billion each. Invitation Homes and American Homes for Rent have only been around for 7 years, and combined their market cap is $23 billion.
God.
Combined they're bigger than those two companies that have been around for decades and decades. Wow. They just show you the demand and the opportunity, and they've only got, I think the 4 publicly traded ones have only got 160,000 homes out of 16 million. There's a lot of growth there.
And that's amazing. That's a startling number that it's that big, that fast, that far. How about and in terms of build to rent, it's also single-family rental as well. That's part of this new.
Well, those are single-family rental homes that got formed with the thesis that I'm going to buy homes below replacement cost. Now, American Homes for Rent has their own construction division.
Yeah, okay.
Invitation Homes hasn't been doing it as much, but the other guys have been buying homes straight from the home builders. LGI Homes announced that 12% of their sales last quarter were to single-family rental companies. So the builders are actually hitting their sales goals right now by selling homes to people that are going to rent them out.
And if you stop and think about it, there's really no reason there shouldn't be build-to-rent actors who are just like apartment developers and apartment builders.
Well, I'm glad you mentioned that because there is a belief in the industry that rentals in the neighborhood are terrible and selling to investors is bad. And that's because under the old model, some landlord may not take care of the property and they might put it back on the market and you'll be competing against your own home. These are professional companies that will only go to maybe 28% of somebody's income on the rent. So they're actually generally more financially qualified, the renters are, than the homeowners. They're going to take care of the property. They have to because they have to keep it leased. And the stigma of, this is a completely different model.
And they're tenants, right? We've seen some of the data from some of these big build-to-rent companies. Their tenants tend to be very, very much like demographically, income, the same people who own homes right around them.
Actually, they're more qualified.
Yeah.
So just to put a stamp on it, a lot of people are going to 43% of their income on debt service to buy a home. The rental guys will only go to 28. I don't know a home builder that runs a background check on somebody buying a home. I mean, they'll sell to anybody, right? Who's got the money. The rental guys run background checks. And in many ways, these people are more qualified. Now, they're probably more transient than a homeowner. But they're finding that the typical tenant in their portfolios is staying for more than 3 years, so they're not that transient.
Yeah, I mean, there are entry level for sale where the typical new buyer isn't going to stay much longer than that.
Well, and the research we've been doing, Ken Perlman and Don Walker have been leading a lot of this, is the master plan guys who really thought this was a horrible idea are now learning, wait a minute, these are people that want to test drive our master plan for a while and then will become homeowners. So you actually want to get them in there to seed your future home sales. We've seen instances in a lot of relocation markets where people just, hey, I'd rather rent for a year. Maybe my kids are buying in the master plan, and I want to be near the kids, but I'm not sure I'm going to stay, so I'm going to rent for a year or two. It's a great way to increase absorption.
Yeah. So we have these kind of sluggish sales trend. Is it completely price that's driving this?
That's a good question. There's a lot of people that are still concerned that we're near the end of the cycle. So maybe there's some confidence. The consumer confidence measures are great.
Yeah.
But there might be some confidence out there. I think our consumer researchers, Sidney Pell and others, are saying that some people are worried, hey, I might be buying at the top of the market, so there might be some fence sitters.
Certainly, for sure, in some markets I work in, that was in the second half of 2018, that was absolutely a concern.
Especially in the Bay Area.
In the Bay Area, those are super savvy buyers. They did not want to buy at the top.
Right.
And they felt it was, for sure. How about bright spots? Are there any markets out there that you feel like are kind of bright spots among this otherwise?
Well, Devin Bachman and I just put together a list of markets, and we categorized them into 5 buckets because they're behaving pretty differently. But at a high level, 13 markets are strong, with 7 of them very strong. And I'd say Orlando's leading the list. Phoenix would be up there. There's a couple that are slow due to lack of supply. Denver would be one. I mean, there's just nothing on the market in Denver, and that's why things are slowing there. But you're not seeing a lot of price appreciation either, like you normally would with only 2 months of supply. I think there's an affordability peak there. And then there's 16 markets that are slow, like in every way you look at it. Existing home sales, job growth is down. LA would be the one that's extremely slow, but the apartment market there is really strong. So it's interesting. We're seeing slowing for sale, but strong rental in that market.
Any other kind of new home bright spots out there? Or?
Well, I think the new home bright spots are some of the pivots some of the companies in our industry have made. So let's pick on Lennar. They're investing in Open Door, which Open Door is only 5 years old, and they're valued at $4 billion already in the private market, so $3.8 billion. And Stuart Miller is saying we're a tech company now that builds homes. I mean, that's a interesting mind shift. One of our clients, Kohler, is now one of the biggest exhibitors at the Computer Electronics Show, where they're winning awards there. Not at they're at IBS too. I went to the CES this year. There were 1,000 exhibitors on smart homes.
Jeez. Wow.
So the industry has become more tech savvy.
Yeah.
You've got the big manufacturer, Clayton Homes, 50,000 homes a year. Just bought 9 home builders in the last 4 years, and I think they recognize this labor shortage, and they're going to figure out how to build not just really affordable homes, but high-quality homes in a factory. In fact, they just announced a big investment in Tennessee to do that. Tricon, which is a private equity company, was all land JVs when I got to know them. Now they own 19,000 single-family rental homes. They just bought $1 billion in apartments. Companies are pivoting, and that's kind of my message right now on the podcast is hopefully you're pivoting too.
Yeah. So that's what these poor multi-million-dollar or multi-billion-dollar companies do to survive is these kind of spread the risk, kind of have alternative strategies.
Well, things have changed.
Yeah.
I mean, things out of their control is changed. There's all this technology that's out of their control, but it's an opportunity. The labor shortage is out of their control. All the cost increases, most of which are caused by local governments, they can't do anything about that. And they can sit around and whine, or they can get going. And these companies are going. Probably a little bit of both.
Is there any, I mean, let's not name names, but is there any danger to new home builders if they aren't pivoting, if they don't have alternative strategies out there, if they just keep doing the same thing?
Well, that's a great question, because most of them say, this is an industry of copycats, and I'm going to let somebody else figure it out. And as soon as they figured it out, I'm going to fall in line. And that might be an okay strategy.
I think with offsite, that's exactly with offsite construction. That's absolutely what's happening in most cases.
That is true. Except I was just with Jerry McCaughey at Integra. And, it takes a couple years for these guys to get up and running in a plant, and a plant can only do 4,000 or 5,000 units a year.
Yeah.
He said, well, what if one of these builders locks me up?
Yeah.
Or buys me?
Yeah.
And one of our clients, Louisiana Pacific, is funding him. So the lumber's not going to come from anywhere else. It's going to come from Louisiana Pacific.
Yeah.
What if you get locked out and then you are stuck?
You other builder.
You other builder, and all of a sudden somebody's building $10 a square foot cheaper than you, or maybe more importantly, they can move somebody in 2 months, and you're going to take 8. That's what you got to worry about.
Yeah. So going back though, are there some things that if builders keep doing them, the same practices that will be potentially scary down the road for them?
I think the companies that are, and I don't hear this as much from the builders anymore because I think they get it, but a lot of the investors don't, particularly the stock market investors. They're waiting for us to get back to 1.6 million, 1.7 million housing units a year, and actually the building products companies too. A lot of them really, because of the supply chain, are 3 or 4 steps removed from what's going on.
Yeah.
And they're just scratching their heads saying what's going on. So there are companies out there that are waiting for this comeback that I just don't believe is going to happen.
So we're not getting back to 1.6 million, 1.7 million. I think
we believe demographically we need about 1.4 million housing units per year, and that includes manufactured housing, and a lot of people leave that out altogether. And I mean, we wrote an entire book on the reasons why. But affordability does play in here, Dean, and you started the podcast with this. If the industry could build $200,000 homes in good locations, we'd have 2 million or more units a year. But I just don't think that's a reasonable achievement with the way things are right now.
Yeah, that's not going to be anytime soon. How about the most important topic to all of our listeners out there? How can people find out about how we can help them?
realestateconsulting.com. There's a lot of information there, and we're passionate about helping people make great decisions. So I'm personally passionate about helping people manage themselves through the cycle. That's why we built up this big subscription business. I know you and our consulting team are particularly passionate about helping people on individual deals really make the right decisions, put the right product in place, price it right, and completely outperform the guy across the street. That's what floats our boat. So if you want some help with that, give us a call.
We'd be very, very happy to do so. Okay. That's a lot to digest in only about 20 minutes or so far. So why don't you go ahead and just sort of sum it up where we're at here in 2019.
Well, sum it up. The year looks to be flat. We're forecasting slightly down on starts, slightly up on sales because we had that inventory buildup in the fourth quarter. You're seeing minimal price and rent growth now. It's growing, but a lot less than it was a year ago. And then the next question out of everybody's mouth is a downturn coming? I don't think this is a downturn scenario, but whenever the next recession hits, I think we're teed up for one. But the good news is we're not overbuilding the market, but we might be oversupplying certain submarkets at certain price points.
Yeah.
And so everybody's being cautious and going to rental and doing these other things.
That has been the biggest difference, is that the oversupply of the last time is just nothing remotely the same this time.
No, and I got a good question for one of my clients this morning. It was like, why isn't this booming like it was at the end of the last two cycles? And I really think you can point to Dodd-Frank, which are regulating the live and hell of the mortgages. So the mortgages are all fully documented. The prior cycle, it was the S&L industry that went ballistic, and those got gone. You do not have crazy lenders, except perhaps in the bond market to companies, where I think there's some exposure there outside of the real estate industry. But that's one of the 7 or 8 things we've pointed to that could cause the next recession.
So some of the companies may be at risk, but from the market perspective of supply and demand and buyers, that's still...
Yeah, and it's not housing companies, it's healthcare companies and tech companies. I mean, companies have been able to borrow a lot of money at very low interest rates and have been spending it and are now having to reel that back in.
It's still a little nerve-wracking, though, because jobs supposed to equal
Right.
demand, and so that could be dangerous there.
I don't want to end on a negative.
I know,
note,
I don't either.
So I mean, things are doing fine. A
Things
lot
have
of times
held
we say,
on.
wouldn't it be great if we just had steady, Eddie, predictable housing market? That's actually what we got.
And I do remember that when things were going terribly, it's like, God, if they just would have been steadier in 2003 and 4 and 5 and 6, we'd be all happier now. So we have steady now.
We have had steady.
Yeah, and so remember this in 2021 and 22 and 23, we had a lot of steady, and things hopefully will be a lot less dramatic next time around.
I don't. That's not going to happen.
Yeah,
right?
that's a given. Okay, that's 2 positive things. Things are steady, and we're not heading anywhere near anything like the cliff we had before.
Well, the fourth quarter was a good
It was a mini
of what it could be like.
Yes, but that was, like you said, a perfect storm.
Right.
All right. Well, thanks for listening. This is Dean Worley with New Home Insights with John Burns. Please say bye.
Bye, everybody.
Okay, we'll see you next time.